Hello everyone, welcome to the channel where we provide education and information. In today's video we're going to discuss an IRA versus an IUL. Now a lot of insurance agents may say, hey, you should not compare an investment with life insurance. Let investment be investment and let life insurance be life insurance. But I think it's a very fair comparison because at the end of the day, life insurance is really a financial vehicle. So is an IRA. Life insurance is really not life insurance. Unlike homeowners insurance, if your house gets burned down, you get money to buy a new house or build a new house, right? If your car is totaled in an accident, they find out what the value of the car is and they get you a new car, right? They give you money for a new car. With life insurance, when you die, you don't get your life back, right? You don't get your life back. You only get one life. So what you're really getting is and there's many reasons for life insurance, whether it's for income replacement, debt repayment, mortgage payment, whether it's for estate planning, retirement income, or just wealth transfer. At the end of the day, it's really providing funds to take care of whatever financial needs that you have. So it's a financial vehicle. So that's why it's very appropriate to compare the two. So let's talk about it, all right? IRA is what's called tax deferred. So what means that you don't pay the taxes now, you end up paying the taxes at a later date. It also has a good rate of return, better than the bank. Bank gives you nothing. You can get a good rate of return. And the reason why you can get a better rate of return is because it's invested in the stock market that pays you a higher interest rate, right? You actually cannot access the money before age 59 and a half, IRS rules, because it's meant for your retirement. Also, you can withdraw money if you had to for specific reasons. Maybe you have financial hardship or whatever. If it's not for financial hardship, then they'll charge you a 10% penalty for withdrawing it before 59 and a half. Also, at age 72, you're required to start taking money out. It's called RMDs, required minimum distribution. You have to start taking money out. IRS rule again. You do have a beneficiary here if you die before you use the money, but it will be taxed. Okay? So it's tax advantage, meaning it's tax deferred, but it's not tax free. Okay? Over here, in an IUL, it's tax free. You don't have to pay taxes. The growth is tax free, and all the accumulation, all that is tax free. It has a very good rate of return because it's tied to an index in the market, but it's not invested in the market. And for an explanation of that, you could actually watch my IUL video where I go into details of how that works or what it means to be tied to the market. So it's not invested in the market, which means you're not at risk for market volatility. It's very liquid. You can access the money whenever you want. When you're taking money out, you take it out in the form of a policy loan, which means you don't pay taxes on it with loans. With loans, you don't pay taxes. Has no penalty for taking out anything. You do pay interest on the loan. With every loan, you have to pay interest. It has a death benefit, and your beneficiary actually receive the money tax-free. So let's recap. Let's look at them. All right. So tax deferred versus tax-free. A lot of people think that when you defer, and they're told this, when you defer, you're going to pay taxes at a lower tax rate or tax bracket at your elderly age, which is not true because think of it. If you have more money, if it's grew more, you're going to end up paying more taxes, right? Less money, less taxes, more money, more growth, more taxes, right? Also, at your elder years, you tend to have less deductions, right? Most of the time, houses are paid off or is paid off. You don't have any dependents, so you have less to deduct from. So you end up being in a higher tax bracket than what you're told you're going to be in a low tax bracket because of your age. But you actually end up paying more taxes. tax-free, which is better. You don't pay no taxes over here. Good rate of return, both of them has good rate of return. The difference is that one's invested in the stock market where you can actually lose money as well. So for example, if you had $1 million in there and you 1 year you gained 20%, so now you have 1.2 million. If the following year there's a rough year in the market, whatever you're invested in, you can lose that money back. Over here, if you had a good year and you get 20%, 1.2 million, now that's protected. So the next year, if it's bad, you don't lose any of your new principal. So now it's 1.2 that's protected. You don't lose anything. You might not gain, but you don't lose anything. So here, you get to participate in the gains, but and take advantage of it. But when there's a loss and it goes down, you lose nothing. All right. This is very liquid over here. You can access your money whenever you want. You don't have to ask any questions. And the good thing is that while you borrow against your policy here, your money is still growing. So you're not withdrawing like here. You're not lowering your principal when you by taking money out. You're actually using your money as collateral in an IUL, and you're borrowing against your money. And the insurance company is actually loaning you the money. So your money is going to still stay in your policy and grow. That's a great benefit that this doesn't even compare, right? No penalty for accessing your money. We already talked about there's a 10% penalty over here where you would have to pay if you withdraw your money before 59 and a half. You can withdraw your money anytime there. There's no required distribution. It's your money. You do whatever you want with it. You take out whenever you want, and you could leave it there and not borrow from it. But again, if you even borrow from it, your principal, your money's still in there growing anyway. Over here, when you transfer to your beneficiary, they do pay taxes. Over here, the money that's transferred to your beneficiary, no taxes. So, I mean, I've just given the facts. I'm sure you guys could see which one is a much better financial vehicle. Based on the facts, these are not things that I make up. These are actually the facts. Now, here's the major difference I would say. Besides what I just explained there and all, if I'm going to summarize the major difference, I would say the major difference is over here, lack of control. And over here, control. So over here, this is a government type of investment. The government set it up so you can follow certain rules. So you have to follow the government rule. They're telling you when you can take your money out, when you can't take your money out. We're going to penalize you if you take your own money out. And by the way, we're going to tell you that at a certain age, you've got to start paying us. You understand what I'm saying? So that's the government tells you what to do over here. You can't just do whatever here. Over here, you have full control. You could take your money out, borrow against it whenever you want, no questions asked. You don't pay any taxes for it. And when you want to, you could pay your loan back whenever you want. Okay, you don't have to pay it back right away. You can pay it or not pay it. And then it's taken away from the death benefit when you die. So if you choose, hey, I don't want to pay this loan back, you could actually let it sit there and it will be deducted from your death benefit. And no penalty for anything. It's your money. You're not going to be penalized for taking out your own money, right? And here, when it's transferred, you transfer it to whoever you want at no tax penalty at all. You transfer it, the wealth transfer principle here, tax-free. So control. This is yours that you control, that you do whatever you want, and it's a lot more flexibility, a lot more liquidity, and you can access your money whenever you want. Here, lack of control. Government tells you what to do. Government tells you when you can take your money out, and penalizes you if you take it out before you're supposed to. And when they want their cut, they tell you you've got to start taking it out. So I hope you see the major difference there. And as always, if you find the information valuable, please do me a favor and hit like, and also share it with someone that could also benefit from this information, because a lot of people don't understand how an IRA works versus an IUL. A lot of people don't, and a lot of times they wait till later and they're figuring out when they have a lot of taxes to pay, like, hey, what else can I get to kind of take some of this tax burden off me. So share it with someone that you could think that you could be beneficial for them. Also, if you haven't already done so, subscribe to the channel and hit the notification bell so that every time I drop a video, you're notified. And if you have a question, please put it in the comment section and I'll be sure to answer your question. Hope all is well. Hope you enjoyed the video. Until next time, see you soon.